Mona, I'll start with you. You look at that inflation report, particularly when it comes to consumer prices. Airfares down, used car prices down, egg prices, which we've all been obsessing over for the last couple of years, finally dropping back to down to something that's somewhat more reasonable.
Yeah, Romaine, look, it was a nice week in markets for the bulls and certainly for investors and consumers broadly. I'll highlight three quick things. And one, of course, is that CPI report that you mentioned. And in fact, inflation broadly surprised to the downside in both the CPI and PPI prints. But the good news was in CPI, not only headline inflation, but we did see a bit of cooling in core inflation as well, driven by downward pressure in the housing market, and even that non-housing services inflation that the Fed is tracking carefully started to ease as well. Number two is the Fed itself. I think markets are now looking for perhaps one more rate hike coming out of the Fed, and maybe they can step to the sidelines after that. That is welcome news after putting upward pressure on interest rates for the past 16 months, raising borrowing costs for consumers and corporations. And number three, of course, is the economy. The economic surprise index, choose your choice of surprise index, has been moving higher here in the U.S. The economic metrics are surprising to the upside. And of course, this morning, we did start to see in earnest some earnings reports coming out of the big banks. That helped confirm that, in fact, we are seeing a resilient consumer and an economy that's holding in there. So we have a backdrop of lower inflation, perhaps a Fed moving to the sideline, and an economy that's holding up. That's good news for markets broadly.
Well, Dennis, I want to get your thoughts here on those economic tea leaves. Because these are kind of the two big components of this economic narrative, right? Whether inflation is coming down to a reasonable enough level, but also whether the economy is still in stable enough condition following 5 percentage points of rate hikes out of the Fed.
Yeah, you bring up a really important point, and we have to go back to why markets have done so well. We know that inflation is coming down, but inflation appears to be coming down, for now at least, not the hard way. It can come down two ways. The easy way, which would be associated with a soft landing, or the hard way, which would be associated, obviously, with a recession. And so it is clear that it's coming down the easy way for now. This could change. And part of the reason we saw this big shift in internals in the market, so small caps outperforming, like you noted at the top of the show, retail stocks outperforming, deeper cyclicals bouncing, is because the housing data stabilized. And the housing data stabilizing, because that is the tip of the spear when it comes to interest rate policy. You saw the peak drag in housing, as far as residential investment as percentage of GDP, in 3Q and 4Q of last year. It's now a positive contributor. It's not going to take off. But if the most interest rate sensitive sector is already bottoming and the employment backdrop is still pretty firm, that suggests that 5% or a little bit above that is not restrictive. And if 5% is not that restrictive, then we all increase the odds of a soft landing, especially if those core measures of inflation are starting to come down. So that's the really important positive backdrop we have seen.
So, Dennis, though, we spent, last year and a half talking about this great recession that was headed our way. Is that now just so far off in the future that the markets can just kind of do what they want?
I would argue that it's at least 12 months out. So 12 months could be an eternity in our business. I don't know if it's so far off in the future. I made a little too bold of a statement by saying 5% might not be that restrictive. It's probably somewhat restrictive. So if you left rates of 5% forever, you'd probably have some deterioration or severe deterioration in the economy. But I would tell you, over the next 6 to 12 months, the odds of a recession are pretty low. There's a lot of inertia in the economy. The labor market backdrop. It's not just going to fall off a cliff if financial conditions are not going to tighten more.
Well, one interesting thing, Mona, that I thought we saw in equity markets this week was the relative outperformance of cyclical stocks, something that we haven't seen, at least not on a consistent basis, for quite some time. There seems to be a little bit more appetite to embrace the type of companies that would benefit from an economic upcycle.
Yeah, I think that's absolutely right. And look, we've seen in the first couple of quarters, markets have been led by a very narrow set of leadership. We call it, whether it's the Magnificent Seven or just three sectors, tech, consumer, discretionary, and comm services, that have been leading the way higher. It is certainly welcome over this past week and really over the last 3 to 4 weeks to see a little bit of broadening in that market leadership. So to your point, cyclicals have started to show signs of life, areas like industrials and materials in particular, and small caps are showing some leadership as well. They outperform both the NASDAQ and the S&P 500 this week. Now, that is a sign to us that investors are really starting to believe that perhaps the economy will get through the next couple of quarters without falling into any sort of meaningful downturn or recessionary period. Usually when we think of a recovery basket in the economy, it is small cap stocks that lead the way.
Yeah.
Now, what we would caution against is kind of extrapolating the 17% return we've seen in the S&P over the first half of the year
Right.
to a straight line higher in the second half. You know, we would expect some bouts of volatility, especially if the economy maybe doesn't head into recession but softens.
Yeah.
But really for us, those are opportunities that investors can use for positioning then for a more sustainable recovery ahead.
So there is a certain message, I think, coming out of the equity pricing, Mona. But this week was also a really wild week for treasuries and a really down week for the dollar. And I'm wondering, what message is that sending? What message are those investors sending?
Yeah, you know, it's a great point. And look, treasury yields were heading towards their all-time, or at least highs for this cycle, as we started to hear more and more about a Fed that continues to raise rates. But since the inflation data hit earlier this week, we've seen a reversal in treasury yields. And in fact, now markets are thinking, you know, last rate hike, extended pause, and then perhaps a pivot lower in 2024. So we've seen really yields come in and the dollar come in. When you think about it, that is better news for bond markets broadly. We do think extending duration or thinking about extending duration at this point makes a lot of sense. You're not only locking in some of these better yields, but you have this potential for price appreciation if the Fed does over time pivot lower as well. We'd say briefly on the dollar, you know, relative to a lot of the global central banks we've been seeing, especially in Europe, UK, perhaps even Japan, the Fed may be the first to pause and pivot lower. They're still facing a lot of inflationary pressures, particularly out in Europe. And so this relative interest rate differential is showing up in the dollar. And that's really supported international equities this week, EM equities this week, which also staged nice rallies heading into the last couple of days.